Hello and welcome everyone to my channel, The Quality Investor. Last week, I spent some time in Seattle. I went there for the weekend to explore the city a bit, and then I spent a few days during the week there for work. Seattle is a vibrant American city. Tucked away in the far northwestern corner of the United States, it is sometimes overlooked as a top destination for Americans. But from boutique coffee shops on every corner to fresh seafood and its many restaurant options, or kitschy tourist traps in downtown Seattle, the city has much to offer. Originally, I planned to do a video featuring Amazon, headquartered in downtown Seattle. But having flown in on Alaska Airlines, and as I was reviewing my itinerary saved on Microsoft OneDrive, while wandering around the Amazon spheres, affectionately known as Bezos' balls, I realized something. I was heading to historic Pike Place Market, home of the first ever Starbucks, to do touristy things. Later, I was heading to my client for business, Seagen, which specializes in cancer drugs. What I realized is that Seattle is home to some powerhouse businesses that have become iconic global brands and are part of everyday life for nearly all Americans. Seattle is home to 12 S&P 500 companies, as well as many others that are household names. I thought it would be interesting to create an investment fund based solely on companies headquartered in the Seattle area. Would such a fund beat the S&P 500? How diverse is Seattle's economy? Does the region grow faster than the rest of the United States? All right, let's get into what such a fund would look like. But first, hit that like button, and if you find content like this enjoyable, please subscribe to the channel. Also, hit that notification bell so you can know right away when I post more stock analysis content. Looking at some of the logos of the businesses that would make up a fund of Seattle-only investments, it's pretty impressive. Perhaps you start your day with coffee from Starbucks and updating some Excel files on Microsoft Office. Then maybe you do a bit of online shopping at Amazon before heading out for another shopping trip to Nordstrom to update your wardrobe, and then to Costco to pick up some wholesale staples for the rest of the year. In between, you text some friends with your T-Mobile phone plan. To end the day, you check in on Zillow and Redfin to view the latest homes on the market since you're moving soon. Well, all that money you spent eventually makes its way back to Seattle, and there is certainly some serious wealth in that city. The homes on the shores of Lake Washington attest to this, from tech titan Bill Gates' home to the home of a former Microsoft executive featuring a real dinosaur skeleton as a living room piece. Let me set some context here for what we're trying to beat, the S&P 500, and what those returns look like year to date on a 1, 3, 5, and 10-year basis. So we can see here the S&P 500 year to date has returned a very impressive 17.5%. And on 1 year, it's returned 14.38%. Historically, of course, the average S&P return is between 9 to 10%. On a 3-year basis, the S&P has done a little bit below its historical average at 7.74% annualized 3-year return. And on a 5-year basis, it's right at its average, a 10.53% return for 5 years annualized. And finally, the 10-year return for the S&P 500 has been 9.64%. So what we're looking to do is, if we created a fund of just Seattle headquartered companies, would they beat these averages from the S&P 500? Okay, I'm here at stockrover.com, which is my main stock screening tool. And here I'm looking at all the companies that are headquartered in Seattle that have above a $500 million market cap. So these are an equal weighted basis. And here we can see the 1-day return, 1-month return, all the way up to the 10-year annualized return. And on an equal weighted basis of all the companies headquartered in this area, on a 10-year basis, it would return annually 12.6%. So it would have beat the 10-year for the S&P 500 by a couple percentage points. And on a 5-year basis, it would have returned 10.7%, also beating the 5-year of the S&P 500. However, on a 3-year basis, remember that 3-year was just over 7%. Well, it actually would have lost you money on a 3-year basis return here. And we can see that's pretty much due to some of the smaller caps not pulling their weight here. I mean, Zillow also coming in at a negative 28% compound annualized return over the last 3 years, so not great. On a 1 year, we also would have beat the S&P 500 at 15.8%, just over 1% of that beating on a 1 year. And then on a year-to-date return, we'd be clobbering the S&P 500 right now at a 22% year-to-date return versus the S&P of 17%. So on the surface, an equal weighted fund looks like it's pretty impressive when compared to the S&P 500. What if we were looking at companies just in the S&P 500 that are headquartered in Seattle, however? Well, here it gets even better. So on this list right here, we're on a 10-year basis, we're returning 15.6%, well above what the 10-year for the S&P 500 was at 10-something%. And on a 5-year basis, we are returning 13.1%, also above the S&P 500. And on a 3-year annualized basis, we are returning 7.9%, which is just about even with the S&P 500. However, both on a year-to-date and a 1 year, we are returning, again, much more than the S&P 500, 18.3% on a 1 year and 24.4% year-to-date. Both of these returns any fund manager would kill for. And the best company on a 10-year basis, by the way, is not Microsoft or Amazon. It's a semiconductor company called Monolithic Power Systems, which of course makes sense since semiconductors are one of the fastest growing industries in the United States and the world, and semiconductors power the modern economy as we know it today. A few other notable companies in here, of course, Microsoft, that everyone knows, and they always beat the S&P 500. They're one of the kings of compounding. Amazon, of course, can be very up and down, but they've had a very good run the last 10 years, returning 22.9% compounded annually. And of course, the third largest carrier in the United States, T-Mobile, has returned a very impressive 19%, which is actually far better than its competitors, Verizon and AT&T. And of course, everyone's favorite wholesaler, Costco Wholesale, has returned at a very impressive 18.9%. This company is one of the best companies in the world, has one of the best business models in the world, and is always trading at a high premium. PACCAR is a farm and heavy construction machinery company. Their main competitors, of course, are Caterpillar and Deere, and they've pretty much returned about the even amount with both of those two companies. Expeditors International is a logistics and trucking company, also returning a very impressive 12% on a 10-year basis. And of course, Starbucks, that great coffee company, is also returned 12.1% on a 10-year basis. And of course, we have some other companies here. To be honest, I'd never heard of F5 or Fortive before doing this video. But there's F5 is a software, and Fortive makes scientific instruments. Alaska Air, of course, is actually one of my favorite airlines. I've flown on it twice, and both times to Seattle. And they are definitely a very good airline. However, they have not been returning very well, which is very typical of airlines. It's a heavily regulated industry and requires a lot of CapEx investment to even break even. And then, of course, we have a real estate REIT here, Weyerhaeuser, which is an interesting company. They're actually a real estate company that owns a lot of forest land, and they're organized as REIT. However, they also sell wood products, and that segment of the business is treated for tax purposes just like a regular business. So it's like a REIT / regular kind of business combination. An interesting combination there. But however, they're very below average returns at 4.7% on a 10-year basis. So the next thing I did here was I constructed a dummy portfolio as if I was trying to invest in these companies, how I would allocate funds to them. And of course, I would allocate most of my funds to the big three, Microsoft, Amazon, and Costco. In real life, I own a lot of Microsoft. I do not own Amazon or Costco. However, Microsoft is by far my largest holding in real life. And in this portfolio, I have it making up nearly 17% of the portfolio. Amazon is at 16.6% of the portfolio. Costco coming in at 13.2% of the portfolio. The fourth largest is Monolithic Power Systems, a semiconductor company like I mentioned before. I'm also very bullish on semiconductors in general, and so I've allocated nearly 10% of my portfolio to this. In real life, I do own a lot of semiconductor companies. I do not own MPWR, however. The fifth largest is T-Mobile at 8%. Starbucks at 7.5%, and then the rest of them are companies that I would probably hold. I'll go through each of these really quickly. Expeditors, Fortive, CGen, who is my client, Paccar, F5, Smartsheet, which I've used their software. I'm not too fond of it, but I did put them in here for the purposes of this demonstration. Zillow, Redfin, which I've used extensively in my own home searching. And then, of course, the lowest two are Nordstrom and Alaska Air. To be completely honest, I would probably never own a Nordstrom or Alaska Air in real life. I avoid airlines like the plague. I think they're just terrible investments in general, although Alaska Air is a well-run airline from a customer standpoint. And Nordstrom, of course, again, retail is just not exactly something I'm big on. I do own a few retailers in real life. However, Nordstrom would not be one of the retailers I'd ever really look at, but I did include them for the sake of this demonstration. So one thing I do like about Stock Rover is you can create these portfolios and then it does all that back testing for you. And I'm benchmarking against the S&P 500. So what do our returns look like on a back-tested basis? All right, so let's visualize some of these returns. So we're looking here at year to date of this fund. What would it have compared to against the S&P 500? Well, it would have clobbered the S&P 500 year to date. If I'm weighting my portfolio, like I previously mentioned here, 32% versus 18% for the S&P 500. That's a very impressive return. On a one-year basis, again, we're still beating the crap out of the S&P 500, 24.5% versus the 15.8%. And then on a two-year basis, however, not doing so well. Here we would have actually lost 12% if we started this exactly 2 years ago versus only 1% in the S&P 500. On a 5-year basis, we would be just ahead of the S&P 500, 81%. And on a 10-year basis, we would have very nice returns compared to the S&P 500. A 261.7% total return versus the S&P 500's total return of 202.7% over the last 10 years. So I must say, I'm putting this video together. A Seattle fund looks like a very intriguing prospect. And finally, just looking at what the companies of this hypothetical fund would have returned on an individual basis for our fund over the last few years. We can see here, like I said before, Monolithic Power Systems, certainly the best returning over the last 10 years, with that annualized return of 19.9%, an annualized 5-year return of 16.2%, that 6% return annualized on a 3-year basis, again, slightly under what the S&P 500 did on a 3-year basis at around 7.7%. But on a 1-year and a year-to-date return, just amazing returns. 24.8% on a 1-year basis and a 32.3% on a year-to-date basis so far. So for the questions I posed earlier, would the fund beat the S&P 500? How diverse is Seattle's economy? And does the region grow faster than the rest of the U.S.? I would say yes, it does beat the 500. And we can see here, Seattle has a very diverse economy. There are 7 sectors represented, everything from the communication services with Zillow and T-Mobile. We have a consumer cyclical with Amazon, consumer defensive with Costco, and of course, technology is highly represented with Microsoft, Monolithic Power Systems, F5, and more. An incredible economy, an incredibly diverse array of options if you are living in that city and where to work. Just a very vibrant city in general. And just based on these returns, I would definitely say that the Seattle region is growing faster than the United States as a whole. And if you do visit that city, you will see cranes everywhere lining the skyline. So before we go, I do want to emphasize that this is not financial advice, but I do think it would be pretty interesting to create a fund based on a city. With that, thank you for watching today's video. And what do you think? I love the feedback, so comment below with your thoughts. Also, please hit that like button. And if you found this info helpful, please subscribe to the channel and join our community. Thank you and happy investing.